Your billing cycle is a predetermined amount of time. It is set by the credit card company, and that's the length of time that they use to calculate your bill. So all the transactions in between this date and this date. It can be adjusted based on your credit worthiness. So usually it's 30 or 31 days, sometimes 28, but most companies use a 30 or 31 day billing cycle. But it can be as low as 14 days. So you could get a credit card bill every 20 or every 2 weeks. If you have a bad credit history, or if you end up with a bad history with that particular company, they could shorten your billing cycle to try to make it more manageable for you. But again, you'd have like 2 bills a month at that point, and that kind of is difficult. So you want to keep your credit worthiness good anyway. Your credit card statement is the accounting of credits and debits. Credits are payments. Debits are purchases. This is your bill. Okay. Your account number shows up on the credit statement. Usually it is the same as your credit card number, but not always. It could be a portion of your credit card number, or it could be another number altogether. But it's your unique number that's used for your identification to identify you. Your credit line is also known as a credit limit on some statements. This is the maximum amount that you're allowed to owe at any time. You can end up over your credit limit if you purchase, like say your credit limit is $300 and you purchase $300 and then you get a finance charge that puts you over your limit. That's not good. Being over your limit impacts your credit score because part of your credit score is balances owed compared to credit limits. And if you're over your limit, it brings down your credit score. So you never want to max out your card. I mean, if it's an absolute emergency and you have to do it, that's one thing, but you need to understand what will happen. And then your available credit is the difference between your maximum amount you can owe and the actual amount that you owe. So this is where they take your credit limit minus what you owe, and that equals your available credit. The billing date is the day the statement is processed. So this is the last day of the billing cycle. So let's say if your billing cycle ends on the 20th, that's the day that'll show up on your statement as the billing date. That's also the last day any transactions will show up. So any transactions that you do during the day on that day will probably show up on the bill. But then if 5 o'clock is the close of business, anything you do after that would show up on the next bill. Okay. The payment due date is the day that the payment must be received and processed in order to avoid late fees. Now, if you mail your payment, some of them will give a little flexibility if they receive the payment in the mail on the date, but some of them won't. And it has to be processed to avoid late fees. So I know that like when I go online and do bill pay, sometimes you go online, say for like my electric bill, and I pay the bill online. It takes 1 or 2 days to process and show up as paid. So you wouldn't want to wait until the day the payment is due to pay it. You want to do it at least a couple days beforehand if you're doing it online to make sure it processes in time so you don't get a late fee. And if you're mailing a payment, you want to make sure you mail it in plenty of time to get there and be processed by the due date. This also shows up on the statement. These are both listed on the statement. Okay. The transactions get listed. There's a section on this statement where they list all your transactions. It's all activity on the account during the billing cycle. So purchases with the date and the total, any payments made, any refunds, any fees that you're being charged, like not a late fee, but if it's like maybe the credit card company charges you your annual fee on the same date every year, so that transaction would list under transactions. Then you have debits and credits. Debits are charged to the account, so these are purchases. And credit is the amount of money paid to the account, so these are payments or refunds. And this works backwards from our check register. With our check register, when we made purchases, we subtracted it from the amount of money in our account. So debits get subtracted from a checking account. They get added to a credit card balance. And credits, before, when we made deposits into the bank, credits get added to our bank balance. On a credit card, credits get subtracted from the amount owed. Does that make sense? So it kind of works a little bit backwards than what we're used to. And then the previous balance also again shows up on the statement, is any amount owed before the current billing cycle begins. So it's any balance that's being carried forward. If you have a previous balance, you will pay finance charges. Also listed on statement. It's supposed to be a C. Okay, no previous balance means no finance charge. Payments and credits is the total amount received by the credit card company. So this is any payment that you made, also any refunds for items that you returned that get credited back to your credit card. So for example, you buy a stereo on your credit card and it's not good, you don't like it, you take it back. It gets put into the payments and credits category. New purchases are the sum of all the purchases made during the billing cycle. Again, up until that billing date. Late charge is the penalty charged for a late payment of the previous bill. So if you're paying February's bill now and you were late on January's bill, February's bill will have a late charge. So it's always, because they don't know to charge you a late charge for January until you've already paid it late, so late charges always go on the next month's bill. Finance charge is the cost of using the card during the billing cycle. This is your interest. And if there's no previous balance, there's no finance charge. And finally, your new balance is the amount currently owed. And the way they calculate this is they take your previous balance plus new purchases plus finance charge plus late fees if there are any minus payments. And that equals your new balance, which is the total owed but it's not the same thing as the minimum payment. Well, I guess it could be if you only owed $25 and the minimum payment was $25, they'd be the same, but usually it's not the same. Minimum payment. This is the minimum amount of money that the company will accept without penalties. That is not to say if your minimum payment is $20 and you send them $10, they're going to send you your $10 back. They will take your $10 and they will apply it to your bill, and then you will get some sort of a penalty, a fee or a late charge or something for not paying the full amount. It is, however, better to pay something than nothing at all. So if you ever end up in a situation where you cannot afford your credit card's monthly minimum payment, call them up and talk to them and tell them, I can't afford to send you $25 this month, but I can send you, 10. That way they don't report you as delinquent to the credit bureaus. You might have a late charge or something, but you're not delinquent. You didn't refuse to pay. And those are, late payments is different than delinquent. You know what I mean? So it's always better to pay something. And if you call them and you tell them your situation and you tell them, I can only afford to pay this much this month, sometimes they won't even report it as a negative BIF to the credit bureau. You might get a fee or a penalty charged on your card, but they won't report it as a negative because you communicated. Does that make sense? Okay. Your average daily balance is your amount owed per day, which is used to calculate your finance charge. We talked about that yesterday. The number of days in the billing cycle is the number of days that are used to calculate the average daily balance. Your APR is your annual interest rate, and your monthly periodic rate, which is also abbreviated as MPR, is the APR divided by 12, and it is used to calculate your monthly finance charge. It's a very good thing they do this. If they charge you your annual percentage rate every month, it would actually end up being more than the actual monthly periodic rate. Yeah, and it's actually annual percentage rate. So annual. That's an N. Can't spell. Annual percentage rate, the reason this is periodic is because the month is considered a period during the year. But you can also call it monthly percentage rate if you wanted to. That's okay. Credit card statement. Mine doesn't really look a whole lot like this, but it's, formatting and stuff is at the whim of whoever designed the bill for the company, right? So the information will all be the same, though. All this information will be there, and this part is usually in a box like this. So on your statement, you have your information, and then there's going to be your account number, the billing date, which we talked about. This is the last day of the statement, billing date. Payment is due on February 2nd, so that's the last day they'll accept the payment without a late fee. Then you have all of your transactions, so these are all the purchases and payments listed individually. This date, the transaction date, I want to make a note of that. Your transaction date's the same on a credit card as on your bank. If I bought something today, and today's the 10th, with my credit card, when I get my credit card statement, it might say the 10th, or it might say the 11th or the 12th, because it could be a processed date. It can take up to 5 business days for things to process, like a credit card or a debit card, depending on who you're dealing with. So, like I have one of those Target debit cards. That can sometimes take like until the following week, like into the following week sometimes, depending on what day I fall on. Yeah, you have to make sure you record it. With the credit cards, you don't have to make sure you record it as much because you're not going to overdraft your credit card. However, you do want to know how much you owe. But just so you know, when you're checking transactions, these dates might be a little bit off from the date you actually went there. So don't freak out if the date's like 2 days later. That's okay. Same thing with payments. If you paid your payment, they have to process it. So the processing date might be different than the actual payment date. Then you have the summary section. The summary section has your previous balance. It has your payment. It has the total of your purchases, the late charge if there was one, finance charge, and then the new balance. And the new balance is the previous balance minus the payment plus the new purchases plus a late charge plus the finance charge. That gives you a new balance. Okay? You want to check all this because it's important. Because what if you made a $75 payment and they're supposed to subtract it, but they added it in instead? Accidentally. There was like a computer glitch or something. You never know. Then you have your minimum payment. This is the amount you have to pay. You should pay more. for your own financial well-being, so you don't have to pay that much in interest. Then you have your average daily balance. This is what was used to calculate your finance charge. Number of days in your billing cycle, your annual percentage rate, and your monthly periodic rate, and they divided by 12 to get that. Over here you have your total credit line. This is how much you're allowed to charge, and then your available credit is how much you have left of that when you subtract the new balance. We're going to go back and forth between these two pages. We're going to bounce. And we're going to start with A, which says to explain how the new purchases amount was determined. Well, the way they determine new purchases is they add up all the purchases. So if we go back, we have purchase, 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 purchase. So 75 and 31.85. That was the gift shop and the pizza. Then you have the department store and the bookstore, so 139.10 and 38.50. And when I add those up, I'm going to get 284.45. And then I'm going to check 284.45, and I'm going to make sure it matched. That's important to do on your credit card statement, because if they made a mistake adding up your purchases and they made it like 289.45, you're going to pay interest on $5 extra, and you're being charged $5 extra that you didn't spend. It was correct. Then for B, explain how the new balance amount was determined, and we wrote that down. We take our previous balance and they subtract the payment, and they add the new purchases, and they add the finance charge, and if there was a late fee, they add that too. So if we come back, we have our previous balance was $150.50, and they made a $75 payment, and we have our new purchases, which is $284.45, and then the finance charge is $353, and there was no late fee, which gave us $368.43 is our new. Sorry, I was, I guess, sort of dyslexic there. And now we want to check that against the new balance here, and it matched, and so we're good. So those are the first things you want to check on your credit card statement, that the purchases all added up correctly and that they did the math across the summary portion correctly. Like 999 times out of 1,000, it's probably correct because the computer does it. But if one thing gets entered into the computer wrong, it'll throw off your bill. So you always want to just double check everything. And even, let's say you went to Giza's Pizzas and you have your receipt, and it's not for $31.85, it's for $29.50 or something. That there could be an error here. Maybe the waitress put in the tip wrong, or, you know, I mean, things happen, so you always just want to check. That's all. Just check. Okay, Pasquale has $15,000 on his credit card. That's his limit. His summary is here. That was the same thing that we just looked at, right? Except that was Jane Sharp instead of Pasquale, but okay, whatever. Same thing. So we have our new balance is $363.48. We have a $15,000 credit limit. Yeah, so we already checked that and we know that's correct. So we're just going to subtract that from the 15,000. Okay, you're allowed to spend 15,000. You owe 363.48, which means you have 14,636.52 available. Okay, Myrna is examining the summary section of her statement, and she's checked all these. She agrees with the previous balance. She agrees she made a payment. She agrees with purchases, and yeah, she paid it late. But she does not agree with the new balance. She thinks this is wrong. So we need to figure out, first of all, is she correct? Is this wrong? So we're going to take our 1748. We're going to subtract the $100 payment, add the $800 in new purchases, add the late fee, and add the finance charges. When we add all that together, we get 2,476.15. They were off. What happened? Well, look at how far they were off by. And so if I hadn't taken this $100 out right here, I would have gotten that information, correct? So what happened? They didn't apply her payment. So they wrote her payment in, but they didn't actually subtract it to show that it was paid. So this is one of those things that could potentially happen, so you need to be able to check that and say, okay, call them up and say, look, I just checked all my numbers. You guys didn't apply my payment to my balance. And then they'll fix it. They're required by law to fix it. Remember we talked about those laws the day before yesterday? They are required by law that there cannot be mistakes like this on your credit card statement. They have to fix them.